Sorry, I just realized I've been talking and completely on mute. So it's 11. We have some people in and others are still coming in, but I think we can start. Heather, if you're ready.
Great. Thank you, Sasha. I'd like to welcome everyone to today's webinar that's hosted by the Social Impact Measurement Topical Interest Group of the American Evaluation Association. I'm Heather Esper, and I'm a co-program chair of the Social Impact Measurement Topical Interest Group. And for those of you that are not familiar, the American Evaluation Association is a professional association of evaluators devoted to the application and exploration of evaluation as a profession. We have over 6,000 members representing all 50 states in the United States, as well as more than 80 foreign countries. Our social impact measurement group is called the SIM TIG for short. We're a group of AEA members who are interested in the topic of social impact measurement and management and exploring the interplay between social and financial return on investments. We come from many backgrounds, from evaluators to evaluation commissioners, investors to investees. Membership in our TIG means that you would want to learn more about evaluating the social impact of organizations that are aiming to produce both a social and a financial return. Whether you're just at the forefront of the work or learning about it, we're always welcoming new members. I'll put a link in the chat in a moment so you can learn more about AEA as well as our SIM TIG. Today's webinar is our second in our 2022 webinar series. Each webinar will touch on the 2022 AEA conference theme, which is reshaping evaluation together through exploring shifts that are disrupting evaluation practice. We'll be hosting webinars every other month through 2022. And now I'm going to turn it over to Sasha, our other co-program chair, to introduce the next webinar and then introduce our presenter for today.
Thanks very much, Heather, and thanks everyone for being here. I see a lot of people still coming in, so we already have a healthy number. So I'm Sasha Zueva, and I work on impact measurement and management at Johnson & Johnson, and I'm also on the board of the SIM TIG along with Heather. So I second Heather in welcoming you all to our webinar. We have a very exciting webinar today that's focused on a practical example of using IMM or impact measurement and management strategies at Vox Capital, which is the first impact investing asset manager in Brazil. I'll introduce you to our host, to our speaker in a minute. But before we dive in, I do want to say that this is part of a series of webinars that we've been running actually since last year, and all our webinars are recorded, as is this one, as you've seen, and you can find them all either on the AEA SIM TIG website or on our YouTube channel, which is called the AEA SIM TIG Webinars YouTube channel. And I'll put a link in the chat for that. So all the webinars will be there. And this one will actually, the recording will be sent out to you as well. Our next webinar will be on June 13th at 3 p.m. to accommodate New Zealand as well. One of the presenters will be presenting from New Zealand. And the presenters will be Karim Harji, Laura Budzina, Heather Hishigan, and Penny Hawkins. And they'll focus on introducing concrete tools that evaluators can use to help social ventures align their measurements to the impact creation phase they're in and to the questions at hand. It's a very nice extension actually of today's practical piece. So mark your calendars again for June 13th. And again, we'll put a registration link in the chat. All our webinars, as Heather said, this year are linked to the social impact measurement, obviously linked to social impact measurement, but are also linked to this year AEA conference theme of reshaping evaluation together. And the theme of the three themes kind of comprising that bigger theme are equity, social justice, and decolonization, new funders in social finance, which is actually very relevant to this webinar, and digital data and technology. There is still time, so if anyone wants to submit a proposal, there's still time to propose sessions for the conference and sign up for the conference, which will actually be in person in November in New Orleans, so everyone should come. And now I will introduce you to our today's speaker, and we're very lucky to have with us Daniel Brandao, who is a professional evaluator with an educational background in agriculture and in education, and he has more than 20 years of experience in the social impact sector. Currently, he's leading the impact area at Vox Capital, which is, as we mentioned, is a Brazilian asset manager, 100% focused on impact investing. And he'll tell us more about it now. Go ahead, Daniel.
Thank you so much, Sasha. Thank you so much, Heather, for inviting me for this webinar. I'm going to share my screen. great. And thank you all for showing up for this conversation around impact measurement and management. And the subject of our webinar today is advanced strategies on impact measurement and management, and it's much based on Vox Capital experience. So as said, we are the first Brazilian impact investing asset manager. We were founded in 2009, and we hold currently around 150 million of assets under management, and most of these assets are under venture capital funds. I will explain further about venture capital, the dynamics of it later, because it's important to understand that, to understand our IMM approach, okay? And if you want to learn more, here's our website. And as Sasha was introducing myself, I am a professional evaluator with a background in the nonprofit sector. So I've been working for the last 20 years with mainly with foundations and NGOs. And last year, I was invited to join Vox Capital with this challenge of bringing an evaluator's lens to an impact investing asset manager. So my challenge here is like to bring this very deep evaluation perspective to the way that we manage impact in our asset management. As Heather mentioned, this webinar is part of a series of webinars to warm up our way to the next American Evaluation Conference. I think we are all happy that we will meet on site in New Orleans in November, and submissions are open to April 2002. And in the agenda of this conference, we wear the shoes of a new area influencing the evaluation. And this new area is, as called in the program of the conference, new funders and social finance. Okay, and there's a minor shift in the language here that I just want to note, that for us that we have experience in the nonprofit sector, maybe in the traditional evaluation sector, we use a lot this expression, monitoring, evaluation, and learning, MEIL. And when we come into the impact invest world, we change it to IMM, impact measurement and management, or just impact management. So I will be using this word, but it's quite similar to what we express as a monitoring, evaluation, and learning. We can make some connections between both, okay? Just to have everybody on the same page, when we're talking about impact investment, what does it mean? And we can go over the Global Impact Investment Network, what they state about impact investing as investments which are made with the intention of generating positive, measurable social and environmental impact alongside the financial return. So this draws the lines in which of the field in which we are playing from now on. Okay, and I intend to present to you our overall IMM structure. This is something that we are working hard on it. It's kind of a newborn structure. It's the first time that I'm releasing for such a special audience this structure. So it's kind of it's a huge pretest for this structure. Okay? And we just finished like the final steps of this structure last days. But the way that I decided to present it to you is to unfold the building blocks of this structure in a way that you can understand the development path that led us to this structure. And at the end, we will tie it up so we can have the full picture of this proposal, or as I like to call, the IMM architecture that we have at Vox Capital so far. So we have three main topics to address these structures, and then we have the closing remarks and overview, with the overview and challenges. Okay, and well, I'm Brazilian, so sorry about my accent, but I'm sure that you can understand my message here. And to take off, we must understand some basics about Vox Capital strategy, because our IMM approach responds to our overall strategy. Okay, and there are three main drivers in this strategy, which are the first one, that Vox will grow. In the next years, Vox will grow. And what do we mean by growth? By growth, we mean that we will have more assets under management, more than $150 million. That we will offer other asset classes other than venture capital. And then we will also offer a strong user experience to our investors. The second driver of our growth path is that we will build this grounded on an overarching new impact thesis that we just released. It was released in November of the last year. If you want, it is really an overarching thesis because it is go over the 17 sustainable development goals framed in 4 big dimensions. Okay, if you want to learn more about this thesis, please just send me an email and I'll be glad to send an English copy of this thesis. Okay, it's not really publicly released yet. And the third driver of our strategy is that we want impact investment for all, which means that venture capital is a very specific kind of asset classes, and it's just for the wealth people. You know, it's not affordable for the ordinary people, and we want to make impact investment affordable and that everyone could invest. So we need to look for other kind of asset classes, looking for every kind of ticket sizes, sorry. And so we need different asset classes to bring into our portfolio, okay? These drivers bring us to 2 major topics that will shape our IMM strategy, okay? The first topic that shapes our IMM strategy is that from our impact thesis, we can draw our major evaluative question, which asks, to what extent Vox Capital assets are making a positive contribution toward the sustainable development goals, okay? And I'm assuming that our IMM strategic goal is to answer these evaluation questions. The evaluation question is kind of our North Star of our IMM here. And for our IMM structure, we do have 4 assumptions. I'm presenting the first one, and the other 3 are coming in the next slides. So these 4 assumptions is at the very ground of our IMM structure. The second topic that from the strategy that shapes our IMM approach, or IMM structure, concerns what I was saying about the type of assets that we are managing. So far, as I mentioned, we've been managing VC funds, venture capital funds. Okay. Next year, by March next year, we will have managed other kind of assets. For example, we're working hard to manage fixed income assets and public equity assets. And when I expand the type of assets that I'm managing, and when I look deeper into every kind of assets, I realize that they vary a lot among themselves. So venture capital is a word and fixed income is another word. And they differ, for example, into regulations, governance, type of asset that you can invest in, liquidity, and many other things that I would not dare to list because I'm not from the financial world. I'm from the non-profit world, I'm from the evaluation world, but there are many differences among these assets, which lead me to my 2 other assumptions, that to each specific asset class, a specific IMM would be required. I think it's very rough to bring like an unconditional IMM approach to all kinds of asset classes. You know, you won't get good results. You don't have a deeper look considering the behavior and the traces of each asset. That's why I'm posting the second assumption. And in the environmental growth that we are right now at Vox Capital, what I have is that it's quite impossible to consider that in this exponential growing movement, our team, our impact management team, this is a 3-people group, okay? We will be able to look at every asset and to design and to craft a specific IMM approach to every asset. If it isn't feasible, it will block our growth. So this leads us to our third assumption, that to allow growth, to allow Vox Capital growth, a standardized IMM approach must be considered. to avoid one-by-one designs, which is unfeasible. Okay, so this brings us to the search for what would be a standardized IMM approach that I could frame my overall assets. That's my question. And to standardize anything, we need a basic concept, to be at the ground and the top of what I will build up my standards. So start looking for what would be the basic concept to build on the top of it our standards. And we have this assumption that it must be a globally accepted standard. So I can connect with the global ecosystem, I can contribute with the debate of this global ecosystem, and everybody can understand what I'm talking about. And we found that in the IMP impact classes, there is a key to our IMM standards. Okay, I don't know if everybody's aware of this impact classes. So just to highlight what it means, we have the impact management project. The impact management project came, I don't know, maybe 5 years ago with this proposal of impact classes, and it's formed by a letter, ABC, which informs the impact performance, and it's formed also by a rank of number from 1 to 6 that informs the investor contribution to support the impact of that asset. Okay, I'm sorry if this matrix is a small size and cannot read, but it's just a reference, and you have the link just below the exhibit that will drive you to the impact management website, where you can find all the explanation about these impact classes. Well, we found that, well, okay, maybe we could build upon the IMP classes because there is something here. But then we move forward, studying this idea, and we realize, and this leads us to our last assumptions, that maybe we should just take a closer look at the investor contribution. Okay, so I'm not considering to my standards the impact performance. I'm considering specifically the investor contribution. Why? Because I have this fourth assumption, which states that the more effort from investors, more evaluation robustness is required. So I will balance my IMM guidelines or my IMM approach, considering the effort that I put in the system, considering my contribution to the impact. Okay, so I pick the investor contribution, which are made through the balance or the blend of four aspects. That's signal that impact matters, engage actively, grow new undersupplied capital markets, and provide flexible capital. So these are the four main aspects of the investor contributions. And depending on the way that you blend it, you come out with this 1 to 6 rank that defines your investors' contributions. Okay, I'm not going to read all this, but what you can see that 1 is the lowest contribution that you have, and 6 is the highest contribution that you can have. And for 5 and 6 that I have painted in gray, because this is regarding flexible capital, okay, which means that you are exchanging impact for financial returns. Okay, we are not there yet. We are at Vox Capital. We are focused on providing market competitive returns. So our ranks go from 1 to 4 so far. Okay, so what I have here, I decided that the ground of my standards will be this globally accepted concept that IMP classes, impact classes, and specifically the investors' contributions. So I will put this at the ground, and on the bottom of it, I will build my IMM guidelines. What does it mean? It doesn't mean that I have this intention. I'm proposing that to each of these points in the scale, I set specific guidelines that each investment, that is labeled with 1, 2, 3, or 4, 5, must follow in its impact measurement and management. And what you can see here is that this is a cumulative guidelines. This is a cumulative guidelines, which means that as I move from 1 to 6, I am adding other complexities, I'm adding other guidelines to each point in the scales. So starting at number 1, what do I have here? I have an impact thesis, very basic. I have positive screening. And for public equities, I can go with controversial analysis. But if I have an investment that is labeled like 2, B, A, C, doesn't matter, A, B, C, wherever, 2, then I add an ESG analysis. And if I move forward to the rank to 3, then I add an output tracking, and if it crosses a specific hurdle, I can set the demographics of the customers of the products that we are delivering or the products in which we are investing in. Okay, and then moving to our last point in the scale, we add at the top of all these guidelines the outcome-oriented evaluations. So for those that are used with the evaluation field or landscape, those outcomes-oriented evaluations that are really kind of ordinary in that field, they just come in the scale to those investments that are ranked as a 4. Okay, so I have this cumulative price. And for number 5 and 6, I have the same guidelines as I have to 4. Okay, so with this, I set my standards. I'm saying that to my portfolio, every investment that fits in a 1 must obey this kind of guidelines, and all the others that fits in 4 must obey this kind of guidelines. So my standards are set. But to move forward, okay? Oh, sorry, yes, there is just a picture here that it means that to each kind of investment, each kind of rank that you have, you can tell different stories of your impact. So you have the very basic stories for the number 1 investments, because you don't have that much evidence and don't have that much robustness in your assessments, etc. So you can say about the intentions through the practices, you can say about the commitment of the companies, and you can say that these companies, they are not making any harm to people or the planet. And you can say something else when you go to the 2nd grade, and you can say something else when you go to the 3rd grade, and you can say a lot of things about the impact when you are in the 4th grade. So it helps also to balance expectations with investors. So if I have an investor investing in a number 1, for example, asset, he is aware or she's aware or they are aware that this is the kind of information, or this is the kind of management that I will provide to them for them to follow their impact of their investments. Okay, but that's great, but this is theoretical, no? So far, I had to find a way to bring this to the operational level. And these guidelines just set the boundaries, but they don't say how can I roll out in the real world. And to roll out those guidelines in our world, we set the frameworks and tools to each of those ranks. Okay, and I will present as our practical experience what we are doing, what are our frameworks and tools to the C4 funds that we have so far. Okay, and why I'm choosing C4 funds, because they are where I have the deepest impact, where the potential of the deepest impact. Yes, but also because this is an overview of Vox portfolio. Here we have 6. You can find 6 funds. 1, which is in B1, this fixed income fund. It's in its initial phase. It's a planning phase. It's here just for pedagogical purpose. So what we have are these 5 other funds, and you can see that most of our funds are plotted in the C4 cell. Okay, so that's also why I'm choosing to framework and to define the tools of this kind of investment, because this is my real world. This is where I'm working at. And these are the guidelines. I'm just recalling the guidelines for this kind of funds. Okay. I'm sorry, I just forgot to say that I will go to the questions at the end of this webinar. Okay. So just if you want to just write down your question in the chat, please just feel free. But I will just go over them at the end of this presentation. Okay. Venture capital, a brief line, because this is a specific asset class. And what does it mean? Well, there is a universe to understand what is venture capital. But the basic line, I took it from Investopedia. That's a great source of learning to investors. And it's an investment in which you provide capital to a company, and in our case, to a company which holds an impact intentionality. It's very important that these companies, they really have an impact intentionality in exchange for an equity stake of this company. So we buy a piece of these companies in the very early rounds. So we go into these companies to buy in the seed stages, Series A, Series B, because you can buy these stakes, in many different rounds. So it's part of the VC logic, and we go in the various stage rounds. So we are in many cases we have a seat in the boardroom. No, we really have an incidence, an influence in the governance of this company, etc. So this is why it's very specific kind of assets. So considering that we are talking about VC funds, V4 funds, this is I want to display the framework, the IMM framework that we have developed so far for this kind of assets. And the first thing is to draw out maybe the flow of the investment and the flow of the impact management. And of course, this cycle, this is the IMM cycle for our C4 venture capital investments. But this cycle is very connected, it's bound with the investment cycle because we work as a team, So it's also much of the logic in which the investments are made. And everything starts with a thesis. And the thesis defines and it states the intentionality of impact of that specific fund. And I'm not talking about the overall thesis of Vox Capital. From that thesis, I can pick some specific parts that I'm interested in, and I have kind of a spin-off of a specific thesis for a specific fund. Okay. Then we start an origination process, which means that we're searching for companies in which we can invest in. And we are looking for companies which has a great potential to grow. And of course, they are aligned with our impact thesis. And this is all made by the venture capital team. Once we find this kind of this company, we move forward to the deal. So yes, there is an opportunity there. We can make a deal, and just to make a deal is just to invest in that company. Okay. Then later I will bring the impact tools that we use to all these movements. Okay, and just laying out the overall cycle here. Once this company is now in our portfolio, then we start this long portfolio management, and it can take 5, 6, 7 years. I just forgot to say that venture capital, it's a long-term investment. It can last until 10 years, so it's very illiquid. So that's why it's also to a very specific profile of investors. So we can follow this company during all this period. You go, and then in this period go doing impact tracking. That's just simply go recovering and gathering outputs, impact outputs from these companies. But at the same time, we have a specific strategy that we can look in what I like to say, an impact deep dive approach. So we can better understand the impact of some companies. And I will tell you further how we do it. But at the overall portfolio, we have this impact tracking. And for some specific companies, we can have a deeper look with our impact deep dive. Then at the exit, we sell our position, we sell our stake. That's when we can make some profit from these investments. And theoretically, we should help the companies to sustain the impact after exit, but so far it's still a challenge that we are facing. And of course, from the deal to the exit, we are always informing, disclosing information about the impact and what's going on to keep accountability with the society and with our investors. Okay, so here's just an overview of what kind of tools do we have to reach us. So this is rolling out. How can I roll out? These are tools that we use to follow the impact of these companies. Starting with the impact thesis, I just mentioned it. In the origination phase, we have a protocol, an interview protocol that we call Impact First Opinion, that we as an impact team go and interview the founders to understand if they do have an impact intention. And there's an issue here about impact retention, but this would be really another webinar. We could just talk about impact retention, how we can find out if founders, they do have that. I won't go further on this topic exactly here. And fear of change. We do facilitate workshops, to craft fear of change of these companies before the deal, and in a regular basis. Now, there is some exceptions that we do it after the deal, but the idea is here is that fear of change, that's an ordinary tool that everybody is aware of. What is a fear of change? Help us to understand if that company has some impact and help the founders and the C-level to really understand the impact they want to deliver to the world, to the people and planet. Then we move forward to the deal, and when we present the deck of the deal to our investment committee, it comes with the 5 dimensions of impact from IMP. No, it's another very important concept of what, how much contribution, risks, and I'm forgetting one, but it's all right. Then, once it's in the portfolio, as I said, we have a quarterly output tracking. So we are gathering output information in a quarterly basis for all the companies of the portfolio. And we have for this portfolio also in an annual basis, we run a impact assessment score. And I will say further about this impact assessment score because it's very important to our strategy. For impact deep dives, what we have outcome-oriented evaluations. And what kind of outcome-oriented evaluations? We can commission an external evaluation, but so far it's quite hard to afford for many external outcome-oriented evaluations. So we are starting an approach to develop some internal evaluations, which means that I do have an evaluation background, so I can design. It's quite easy for me to design some basic evaluations, and we, as an asset manager, we can evaluate some of the assets in which we are investing. Okay? Yes, there's a topic we can discuss here, but this is the track we are following, the path we're following. And to disclosure, we have many reports, and we have our annual reports. Just a final comment here, this system is being verified by Bullmark. It's a renowned consultants agency, and they have a service that verifies your impact guidelines and impact practices. And it's undergoing right now. We may have the results by the end of this month. Okay, why we are doing that? Why we're doing that? Maybe more 7 to 10 minutes. Why all this complexity of tools and cycles and frameworks and whatever? Because we need data. The basics here is very simple. We need data. And why we need data? Because I have a major evaluation question to answer. And I have time. That's a long-term evaluation. I'm aware of that. I must be answering that question until 2030. But to answer any evaluative question, I need data, every kind of data, much data from many different sources. And these tools here, they're showing, they're trying, to cover how we can gather data from our companies and our investments. And so we just have a picture here that these are for real. So one impact thesis that we have, one fear of change that we facilitated at the end of last year. This is part of the deck that go to the IC, with the 5 dimensions of impact. This is an ordinary curve of outputs tracking. Then we have B score. We have some videos that we're going into a qualitative approach with videos and in-depth interviews, to gather qualitative data about the impact of our investments in the life of people. We have this box summarizing an outcome evaluation that we commissioned from Brazilian University. So just to have an overview of all types of data that we are trying to gather, okay? So because with this data, we can answer our major questions. And coming to the last topic, I would just like to highlight our impact assessment and the impact assessment score. And why I'd like to highlight it, because we as impact investors, we have this principle that, okay, it's fair that we can be rewarded by the market returns that we provide to our investors through our investments, But as an impact manager, I also must look at the impact that I'm generating with my investments. And I should balance it in the reward that I will get as an asset manager. And we found that the B score, the B impact assessment score, would be the best tool to help us on this way. In the venture capital world, you have this device that's called Carry. It's a very specific and technical device. I won't go further on that, but just making a long story short here. Once you invest in a venture capital funds, you can your first tier of return would be the return of your capital, so just the capital that you invested, the baseline. Then you can, if you cross if the financial return cross the first hurdle, you can have a preferred return, which means that it's some kind of index that you also define at the baseline. And here, for example, we have our inflation rates plus 6%. And if the financial return is above also this hurdle, then you get to the third tier, which is the carry. So it's part of the financial returns that you can provide to your investors. And in the venture capital world, what do you have? Most of it goes to the investors, fair enough, and 20% of this part of the financial returns go to the asset managers. In the traditional market, what happens? It just goes to the asset manager and it's done. But to us at Vox Capital, when it comes to reward or financial returns, we also have to consider the impact return. And how do we measure the impact return? We measure the impact return with the B assessment score. It ranks from 0 to 200, and it assesses 5 dimensions of impact of an organization, of a company. And for you to be qualified as a big company, you must score 8 or over 8 points. Okay, so we have this hurdle here. We look at the average points of our portfolio, and the average points of our portfolio must be equal or over 80 points. If it's equal or over 10 points, then we can have the full carry, the total carry. If it's below 80 points, then we just can access half of the carry, and the other part of our carry goes back to investing. This is a very innovative approach, that Vox developed, and we are proud to share this with you because it's a way to pay for impact, and it's a very credible way to pay for impact. It's also externally verified by Bureau Veritas. Okay, tying it up to closing remarks, we come up with this structure. So putting all these building blocks together, here we find our Imm structure. And this Imm structure is at the very ground of this Imm structure. We do have our impact thesis. Okay, so it's ground in everything. At the top of it, I bring my 4 assumptions. And if you disagree with my 4 assumptions, you're gonna ruin my structure. Okay, but I'm being accountable, to display the assumptions in which our structure is based. On the top of these assumptions, I rank the 6 grades of the investors' contributions from the impact classes. Okay, and to each of these grades, I set a specific Imm guideline that each invest, which is labeled with one of these ranks, should follow. Okay, but then to bring it to the operational level, I had to draw the frameworks and tools, to work with it at the ground level. And then I define my frameworks and my tools. Okay, Daniel, why don't you have tools in 1, 2, and 3, or 5 and 6? Because just didn't have time to that. Okay, but because we're still working on this. And why I'm doing this? Because I need data, every kind of data from every source of data. And why do I need data from every sources? Because I do have this, I have to be held accountable for this question. I have to answer these questions. To what extent Vox Capital assets are making a positive contribution towards the sustainable development goals. And the only way I have to answer these questions in a robust way, in a rigorous way, is to have a lot of data. You can imagine that there are thousands of challenges within this structure, but I highlighted 5 to share with you. The first one is to improve the use of findings. So far, yes, we have some findings, but I'm not comfortable with the use we are making out of it. We need that kind of bringing micro pattern to this table with the utilization of fluxed evaluations. We do need to test this model, because so far it's much more, the guidelines is much more theoretical model. The frameworks and tools are tested, but the overall guidelines connected with investors' contributions, we do have to test yet, and we have to develop the other frameworks. We need to improve our data intelligence. Yes, I need data, but I have to be prepared for that, to manage that data. We have to increase our outcome-oriented evaluations. Doesn't mean if internal or external, but we need more outcome-oriented evaluations. And I agree, it's a kind of a different topic. We'd like to debate. We are searching for an impact score. You know, is there any something beyond the impact classes, that is kind of impact score that can help us and the investors to, to make better decisions concerning impact? So this is something that is in our roadmap to the next year. So far, thank you so much. I hope you have understood my message here, and I will read some of the comments or questions if you have any. I don't know, Sasha, Heather, if you want to make some comments while I go through the questions.
No, just wanted to say thank you so much. Such a great presentation, and it's really great. We appreciate that it's really practical, that to really see how you're doing it in your organization. So thank you for sharing it. And I love the approach that you've taken and kind of all the rigor behind it and the thinking behind it. And I see kind of some of that is actually mirrored in the comments. Karim said that, you know, the Vox team is distinctive in doing TOC work with prospective ventures, and I agree with that. That's not always, it's not easy to do. There's actually, we find sometimes there's resistance to putting a theory of change together. It sounds theoretical, it may sound too academic, but it's so important to get everyone on the same page in terms of impact. And I can see that, you know, there are already questions coming in. If you're ready, Daniel, to answer Karim's question, for example, as follow-up.
Yeah, we have some questions here. Thank you so much for sharing your doubts about the presentation here. One question is about if you have changed for debt funds, and no, not yet. Why we don't do it yet? 2 reasons. First, because we're still designing our debt funds, okay, and we don't have any debt fund that is labeled maybe much more, because we're still designing it. I cannot say that we won't do it. I think it's a great tool. We should maybe try to deliver it to all kinds of assets, but so far we don't have that kind of experience. Okay, and Karen Hodges here, he's our master in this impact investing world. I've learned a lot with this guy. And his question here is advice for working with teams with less capacity knowledge on IMM versus those that are more experience aware. What tools or tactics have been most helpful for each type of venture? Okay, wow, tough question from Karen. With those teams that are less advised about impact, well, just a piece of advice. I do believe that we as evaluators and we that manage IMM in our organization, we do have a pedagogical responsibility that we have to educate our LPs, our investors, to better understand impact. Okay, and we do have to educate our peers, our team members, etc. You know, I'm saying that because I'm not finding very tough questions from, for example, our investors. So they are less aware of impact. They have less capacity or knowledge on impact. What would help here? Impact classes, I think, is a great tool, but not everybody can understand it so far. But we are starting to work at Vox Capital in a pedagogical level, so most of our investors can understand what is impact category. Okay, so I think this is a great tool because it's really, you can shape it, you can frame it, so it's really easy for an investor to see it and to realize what kind of impact they would be delivering with their impact. And sorry, I lost. And to those that are much more informed, of course, I do have, we do have this question. I think we have this question in our environment, this for the impact score. You know, I'm kind of afraid of this debate, but I think we have to face this debate, and it would be great to face this debate at the next American Evaluation Association. And I'm aware that CDC is doing an amazing job searching for impact score. It would be great to have some kind of number or something that can inform a little bit about much more, maybe about the expected impact of that asset and not the current impact, but it also would be a good tool for those that are not so familiar with the impact investing world. There's a question here about difference between traditional job. Oh, there's another job opportunity here, sorry. And there is a question, if I'm not wrong, about evaluators. Indicators, amazing presentation. Okay, yes, thank you so much. In the deal definition, question from Ken, a slide mentioning contracting impact. Can you elaborate on the terms of such contract? Good question. What happens if things go worse than contracted? Say if you have straight equity deal with no levers that would come with a more complex impact linked structures. That's a great question. Yes, we do contract impact. It means that it's in the contract that we do when we buy a stake of that, we invest in a stake of that company. And we have an impact management policy that we send to all of our investees, and they are aware of the commitment they are making when they accept us as investors. And in this commitment for the C4 funds, it said very clearly that they must get involved, delivering us impact outputs and get engaged in our impact assessment annual score, and they get very engaged on that. It has never been a problem. So far, what happens if we realize that there is a company that's not really delivering impact? That's a tough question, but we do have experience at Vox Capital with the previous funds. It was our first fund, we call Impact Investing #1. There we made a write-off of one company that wasn't delivering any, it wasn't just delivering, it's not engaged with impact anymore, because you cannot be delivering impact. It's hard to deliver impact. But if you lose engagement to deliver impact, so there's not much that we can do. So, and we realized that with the economic indicators, it was doing fine, but we decided to write off, and to write off in the glossary of the venture capital world means to cut off this investment from our portfolio. We just sell our position on that company. So we do have that here, this experience here. We are on our way to better develop, we are on our way to how could we work with impact-linked finance if it's not a venture capital fund, if we don't have an impact assessment score. We don't have a solution for that so far, okay? So we can have this impact-linked carry for venture capital and for C4 venture capital, okay? So if you go, for example, to a fixed income B1 that we will have managed next year, what are we going to do? I don't have the answer for that. And another question concerning BA score, there's a question if I have a baseline for BA score. Yes, baseline is 80 points, but at the average of the portfolio. So in the portfolio, I have companies with, I have one that has like 114 and another one with 70 something. And from the weighted balance, I have had the overall impact score of that specific kind. But the baseline is, in a portfolio base, it's 80 points. So hard questions. So Karen's bringing hard questions here, but you have first hand. I'm gonna read for these questions, but you have the first hand experience. I've seen you have found and seem to become clear, except as they pivot or scale about the distinction between direct versus the indirect change, negative impacts, what good enough evidence look like, and the distinctions between operational and impact indications. But also informer could be good practice for later. These are questions we all continue to face in IMN, and thanks for sharing your tools and tactics with us. Okay, thank you for sharing your thought here, Karen. It's much more a comment, not really a questions. And yes, totally agree. And myself, as an external evaluation, I'm very uncomfortable with something that, how can I say that? These are some of the standards of the impact investing words. Which are some of these standards? Okay, or assumptions that a fear of change is good enough. You know, so we find some investors that say that, please, I'm not criticizing anyone. I'm just worried about the future of this ecosystem. That a fear of change is something that you can show your intentionality of impact in a theoretical way, and through that you can see direct and indirect impact, but you cannot really follow the current impact. So it's not enough. And we only go to follow the current impact. What we most have are outputs. And outputs are fine, but outputs are the first layer of this debate. And I can say a lot with outputs. And why do I have a lot of outputs? Because it's easy to gather. It's cheap to gather. You know, it's feasible to gather outputs. So we do have a lot of outputs. And how do I define what kind of outputs, what kind of indicators will I look for? Well, that we would need time for this further conversation. Maybe at New Orleans, hope. But it's not enough. So that's why we have this strategy of deep diving with outcomes-oriented evaluations and following the qualitative path and the quantitative path. It's a mixed method approach, you know, and saying that, that's why I, maybe that's my final comment. That's why maybe my skill as an external evaluator can be more useful here. That is to design some internal evaluation and, okay, not very complex evaluation. I'm not talking about RCTs, no. I'm talking about non-experimental evaluations. I'm talking about evaluation of the perception of impact from the stakeholders. I'm talking about maybe some in-depth interviews to understand the complexity of that impact in the life of a person. Okay, that's where maybe my skills as an external evaluator or as an evaluator can be more useful here for this organization and for our ecosystem here in Brazil. I know there is, my final comment, I know there are some critics that how far can I stand up for internal evaluations if I'm not, how can I held accountable for internal evaluations if I do have an interest in that kind of evaluation. Yes, I'm aware of that. I'm not evoking that Google and Lincoln approach, the fourth generations of evaluations. But by this moment, what I want is to have some extra and additional data, and I do believe that internal evaluations can provide that. We will start our first experience with an internal evaluation in May this year, and maybe I will have something to share with you, listening jazz in New Orleans in November this year. Well, we have 5 minutes to the end. Sorry, I'm aware that we didn't cover all the questions, but if you have any other questions, please, I will be glad to answer by email. We'll send you any material by email with these presentations, and I hand over back to Heather and Sasha to the closing remarks.
Sure. I was going to say, I think there's only one question left, Daniel, that you didn't address, and that's the one about the difference between, and it's not an easy one. What's the difference between the MEL and IMM? Kind of new, and how is that incorporated into your approach?
Yeah, that's a good question. And my first response to that question is that maybe just semantics. I don't really see there is a big difference or a technical difference. Maybe it's just about narrative. Maybe it's about languages. Maybe it's about people from different cultures coming each other, but technically, I think it's much about the same. And my closing remark on this, Sasha, is that I would like to address this as something that is kind of bound and it's connected, because I don't want to split the evaluation and then IMM into different words. So if I accept that IML and IMM are quite the same, I set the table to a good conversation. Okay, so maybe there's no difference.
Yeah, thank you. That's helpful. And actually, I have a quick question now that we covered everybody else's. Just, I love your focus on outcomes and that you're really thinking about it in internal versus external evaluation. How do we understand the actual contribution? That's something that we're still, I think, all grappling with in impact investing. How do we move towards outcomes away from outputs? And what we're also grappling with is who pays. So in your case, who's paying for these outcome evaluations and any external evaluations that you'll have?
Great. So far we've run 2 external evaluation, and nobody really did pay for this one. The first one, because there was a partnership with Brazilian universities, and we have master's students, and they were needing data for their thesis, and so we made a partnership. We can offer, primary data and first-hand data for you if you can give back some external analysis of these investments. Mm-hmm. But I tried the same approach last year with Brazilian University, and they offered me back a budget that I would pay for that, and we cannot afford. Even we are an asset manager, we cannot afford for impact. It can sound, yes, I know it sounds weird, but we cannot afford for outcome external evaluation so far. That's why this is what we are bringing to our house. Okay.
Mm-hmm. Great, thank you. That's helpful. We're kind of thinking about all of that as well. But yeah,
Sasha, there's a question here. If you were going to share the presentation, how do you handle that?
So we will share the recording, and if you're okay with it, Daniel, we can also put the presentation online on the AEA website. I think we've done it with other presentations, and so people can access it from there if you're fine with it. Yeah, otherwise the recording will be sent out. It will also be on the YouTube channel. Thank you so much, Daniel, for such a fantastic presentation. Thank you everyone for your participation and engagement. Yeah, looking forward to the next webinar in June. Please join us then. Thanks, everyone.
Thank you so much for the invitation for the audience. Thank you so much for sharing.
Great. Thank you. Bye.